Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 14th of February 2020, and happy Valentine's Day to all of those who celebrate it. On Wednesday, we produced a video entitled EU Industrial Production and Euro Weakness Impact on Silver Prices. And on Monday, Euro falls again as dollar, equities and gold and silver rise, where we highlighted that the Eurozone as a whole was experiencing major production difficulties and that the euro had hit its lowest level for over 4 years against the US dollar and could indeed head lower. Now today we are once again going to speak about Europe as it nicely rounds off this week's theme. Europe is important. Please do not underestimate its importance. It's important for global trade. It's important for the financial markets, as the euro is the world's second most traded currency. Just for interest, the order of tradability is the US dollar number 1, euro number 2, Japanese yen number 3, pound sterling 4, Australian dollar 5, Canadian dollar 6, Swiss franc 7, and the Chinese renminbi 8. But the euro, and this is critically important for the future, no less, it's also the second in weighting terms of the 5 currencies in the IMF's global currency, the SDR, special drawing rights. Number 1 is the US dollar in weighting terms. The second is the euro. The third, the Chinese yuan. The fourth, the Japanese yen. And the fifth, the pound sterling. And this is why, to a large extent, you will notice that we do tend to concentrate primarily on the dollar, then interchangeable between the euro, sterling and yuan, and very seldom, and perhaps we should focus more, on the Japanese yen. Now, Europe is the world's largest exporter of manufactured goods and services, and is itself the biggest export market for around 80 countries. Together, the European Union's members account for 16% of world imports and exports. Now, the US remains by far the most important destination for goods exported from the EU, or they were the figures in 2018, followed by China, Switzerland and Russia. China was the EU's leading supplier of goods in 2018, followed by the United States and Russia. Now, with the UK having left, and when the effects eventually filter through, some of these figures may change slightly, but even then we doubt if any of these changes removes the considerable impact that the European economy has as a whole on global trade. So with this in mind, it's extremely important if we discover that Europe is either teetering on the brink of recession or is about to embark on a major economic recovery. So let's now listen to 2 articles published today, one by Bloomberg and the other by Reuters, and then we shall discuss these very briefly thereafter. Reuters article dated February 14th, 2020, 7:28 a.m., updated at 9:30 a.m. GMT. German economy flirts with recession as fourth quarter output stagnates. By Ren Wagner and Joseph Naser. The German economy stagnated in the fourth quarter due to weaker private consumption and state spending, data showed on Friday, renewing fears of a recession, just as Chancellor Angela Merkel's Conservatives are preoccupied with a search for a new leader. Europe's biggest economy has been losing momentum as its manufacturers linger in a recession prompted by a reduction in exports, while its automotive sector faces disruption from an expensive shift to electric cars. Private consumption and state spending have been providing growth impetus, and if those 2 sectors continue to weaken this year, the risk of recession will rise. Quote, We think the economy will continue to flirt with recession in the first half of this year, unquote, Andrew Kenningham of Capital Economics wrote in a note. One bright spot from the preliminary data was an upward revision in the third quarter growth figure to 0.2% from a previously reported 0.1%. The Federal Statistics Office said investments in the construction sector grew in the fourth quarter, while spending on machinery and equipment declined considerably compared with the July to September period. Exports also weakened in the final 3 months of last year, it said. Merkel's government has resisted calls for a fiscal stimulus to put the economy firmly back on a growth path. Those calls will grow louder if the economy fails to rebound, a likely scenario given that manufacturers are expected to face headwinds from the economic impact of the coronavirus outbreak in China. But Merkel's government is unlikely to loosen the purse strings. Her Conservative Party is in crisis after an Eastern branch voted with the far right to elect a state governor, forcing the leader of her Christian Democrats to abandon her ambitions to succeed the Chancellor. Annegret Kramp-Karrenbauer, who after the scandal said she would quit as CDU leader, is searching for a successor to lead the Conservatives into the next election, due in October 2021. Both Merkel's Conservatives and their Social Democrat coalition partners are likely to suffer losses in a national election. SPD Finance Minister Olaf Scholz has dashed hopes of a massive stimulus by sticking to Germany's policy of no new debt. The crisis in the Conservative Party makes it even less likely that the government will take drastic fiscal measures to lift the economy. Kenningham said the coronavirus, which is impacting both the global supply chain and demand from China, could result in weaker German growth in the first quarter of this year. The outlook for the German economy is also darkened by uncertainties linked to Britain's January the 31st exit from the European Union, as well as the threat by US President Donald Trump to impose higher tariffs on car imports from Europe. Germany's DIHK Chambers of Commerce and Industry said the quarterly stagnation should be a wake-up call for the government to increase investments and cut corporate taxes. Quote, "Now is the time for politicians in this country to courageously do its economic homework. Businesses urgently need relief signals. The fast implementation of investment projects and tax cuts should be high up on the government's agenda," said DIHK's Managing Director Martin Vansleben. On the year, gross domestic product in Germany expanded by 0.4% from October through December, after a 0.6% expansion in the previous 3 months. Seasonally adjusted figures from the Federal Statistics Office showed. Analysts polled by Reuters had expected a 0.1% expansion quarter-on-quarter and a 0.4% expansion year-on-year in seasonally adjusted terms. End of article. Bloomberg article dated February 14th, 2020, 5 a.m. GMT, updated at 9:23 a.m. Eurozone malaise exposes Eastern EU's economic weak spot. The weak link in Eastern Europe's economic advance is being exposed by the malaise afflicting its richer neighbours. 3 decades after the collapse of communism, the nations that went on to join the European Union can nowadays boast of booming domestic demand, driven by lavish government spending and an army of keen consumers. But while not as central as they once were, exports westward remain a powerful force, and the euro area's current stagnation can still weigh on the continent's east, whose factories are wired into its supply chains. And if we take a quick look at this graph, one can see Czech Republic, exports to the EU in black, and exports to the rest of the world in blue. And then if you look at Hungary, almost similar proportions, Poland and Romania. This is a percentage of their GDP. So 65%, 59, 34, 25. Economic growth data Friday revealed a further slowdown in the fourth quarter in Poland, the Czech Republic, Hungary and Bulgaria. Romania and Slovakia quickened. Czech steelmaker Třinec Zalezárny encapsulates the mood. While output will tick up this year, the company is slashing investment by about 40% to 1.4 billion koruna, or $60 million. Quote, "It's significantly less than we originally included in our business plan," unquote, Chairman Yang Tsudek said. Quote, "The overall situation doesn't allow us to invest a bigger amount," unquote. Eastern Europe's economies will nevertheless continue to expand far faster than those in the West as rising wages drive spending. Quote, "We expect consumption growth to continue, albeit at a more moderate pace," unquote. Francois Bloch, Chief Executive Officer of BRD Group Societe Generale, Romania's third largest bank, said by email. But there are other headwinds. Loose monetary conditions that underpinned expansion are showing signs of coming to an end, with the Czech Republic delivering the world's first interest rate increase of 2020 last week to stem inflation, and Hungary also mulling a shift. Elsewhere, the emergence of the coronavirus is already hurting parts of the region, as well as exacerbating an industrial slump in Germany, Europe's biggest economy. Quote, "Hopes for an industrial revival in the Eurozone are slowly evaporating," unquote, said Eliska Jelinkova, an analyst at Raiffeisen Bank AS in Prague, who cited persisting uncertainties. Weaker growth could spell trouble for politicians across the region, who are splashing public funds on everything from pensions to family benefits and state workers' salaries. Hungarian Prime Minister Viktor Orban uses prosperity created under his rule to justify his curbs on democracy. For now, there are no signs of panic. But Radek Spika, Vice President of the Czech Confederation of Industry, sums up the shift that's taking place as Eastern Europe's slowdown alleviates a region-wide shortage of workers. Quote, "Companies had a difficult time looking for employees last year. This year, it will be about getting orders," unquote, he said by phone. End of article. Now, these articles both support and reflect the data that has been received over the past few months, that Europe, as an entity, is indeed suffering. And even those states, the smaller ones, which joined the European Union most recently, albeit quite a few years ago now, rather than growing exponentially or considerably, especially bearing in mind their size, they are not. Further, we reported in our previous videos this week that the ECB, European Central Bank, may have to intervene in the markets before their next official interest rate decision is due in just under 4 weeks' time. See, the deepest concern currently is that not only is the world as a whole suffering reduced growth, but the spread of the coronavirus is simply going to exacerbate the problem. And the wish and hope is that it does not become the major determinable effect on economic growth due to its pernicious spreadable nature. Even Jerome Powell, who was relatively upbeat when he gave testimony to Congress this week, stated, quote, "The Federal Reserve is closely monitoring the coronavirus, its impact on China, and the effect that it could have on global economic growth, unquote. You see, it's not only China he is worried about, as he then went on to express some misgivings about rates being so low, not only with his own Fed, but with regard to other central banks around the world. And with the Eurozone potentially lowering rates again and soon, if the economic data proves as poor as many are now predicting, this will place even greater pressure on what is already, in relative terms, an extremely high-value dollar, with the dollar index still holding firm at 99 as we produce this video podcast. Powell then issued this warning, quote, "This low interest rate environment may limit the ability of central banks to reduce policy interest rates enough to support the economy during a downturn," unquote. Now, this comment was the main focus of the video we produced yesterday, which was entitled "Fed has little room to deal with the next recession," and concluded that the central bank may not have the firepower to fight the next recession, and he called on Congress to get ready to help by way of fiscal policy. And with rates so relatively close to zero, one does not need to be an economist to realize that something extra may be necessary. Now, with all of this going on, the US economic data published this past week has been relatively positive and more or less in line with expectations, and we shall cover this in our weekly update, our gold and silver update, which will be published tomorrow. Now, meanwhile, at the time of writing, the Dow is virtually unchanged at 29,420, but gold has uplifted slightly to 1,581 and silver to $17.74. So please do express your opinions on how you see Europe moving over the coming months. And just as a reminder to those of you who are bronze or silver in the Sanctum members, we have published our silver price forecast for 2020, and you can find it under the premium videos on our website illuminatisilver.com. And of course, we've already published to everyone the 2020 forecast for gold last Sunday. Now, either later today or tomorrow morning, Greg and I shall be providing an update on the coronavirus on our separate channel, Richard and Greg. So do watch out for it, and if you haven't subscribed to that, please do so. Again, as with this one, pressing the bell sign so that you are notified when new videos are actually published. Thank you so much for listening. Until tomorrow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.